Inflation is the big media topic right now. They're scaring us to death with all of these channels. Any TV show, any YouTube video, it's all talking about how much more inflation is going to go higher and how much more everything's costing, how we're all going to go broke. I hope you'll allow me and my opinions to help guide you through this economic clown show that we're all facing. But I'll tell you exactly what I said about inflation before, plus what's going to happen next with it. And I'm also going to show you some charts of how much better the supply chains are getting. They're getting through the backlog really quickly now. Now, nothing we say in any video ever is intended as personalized trading advice for you. And I'll tell you what not a lot of people are talking about, which surprises me. I expected more people to make a bigger deal of this. All you're hearing about is that when there's an inversion in the yield curve, that signals a recession. Yes, it does. But everyone's forgetting another signal of a recession that's happening right now. That is, the stock market is a leading indicator to recession. As the stock market comes down, very often a lot of recessions will begin at that point. That's another indicator of recession. And yes, we're going to have a recession. And people are debating whether or not we're going to even have one, which makes me laugh. But we'll see together in the coming quarters. This video is sponsored by and dedicated to everyone who's joined the Peter Leeds Army. You can learn more at peterleeds.com/army. And what everyone's forgetting in the big picture of things is that after interest rate hikes are implemented, it takes quarters, many, many months to actually affect or impact the economy in any way. It's not going to slow things down within the first week or month or quarter. It takes longer than that. And nobody from the Federal Reserve has ever said anything different. No one ever said that these interest rate hikes will really bring inflation down in a very short window of time. It takes the speed of business, the speed of government. So you're looking at 6 months, and then those interest rate increases will start having an impact, and that'll start bringing inflation down, which would be approximately right now. And I'll show you on a chart exactly the interest rates, where they started, and from there, how they got higher and higher. So it's a reflection of time after when the interest rates are implemented, the increases. It's also a reflection of how steep the actual interest rate becomes or how large it becomes. And a couple other things I want to say is that there's going to be a recovery trade. It's going to be a really great time to get involved, go long on a lot of stocks, a lot of different industry groups, asset classes. But I don't believe it's yet. And I think everybody got faked out the other day. If you remember, I was saying it's a market head fake, and people started buying the next day, and they thought that everything was better now. It's the big V-shaped recovery. That video was almost perfect timing to tell you that don't buy into this market activity to tell you anything. When we get out of all the troubles that I'm telling you about, that I'm talking about, you'll know it. And it's not for a long, long time. We have to have the pain point first. We're not there yet. And when is that V-shaped recovery going to happen? It will almost certainly be around the time when the Fed changes their trajectory. Instead of raising interest rates, they say, well, we've destroyed the economy. Now we're going to lower interest rates. We're going to start quantitative easing again. We're going to do everything that they're doing over in the United Kingdom that is demonstrating to us what not to do. We're going to do the exact same thing as that. And when that happens, and almost certainly before it happens, if it gets projected or people expect it to happen, that's when you're going to start to see buyers returning to the markets and gobbling up a lot of these really highly undervalued assets. But I'm telling you, in my opinion, I don't think we're even close to the bottom yet. And the consumer's still strong. I'll show you that on a chart. And they're still spending, and everybody's got a job. But whenever the Fed does their pivot, they start bringing interest rates down, that's going to be a good time to own shares of stocks. That's typically when a stock market does pretty well. One of the times that it does really well. And here's what I said about inflation exactly. This is from December 14th, 2021. All of that's going to be increasing in price, just as houses and rent have been. However, house prices, in my opinion, are going to come down dramatically. It will just be part of everything else with this big deleveraging that we're about to experience. Inflation will go up a bit more, like I told you, and it'll stop at that level, then it'll start coming back down. There's going to be deleveraging across every aspect of the economy, and that's going to really expose a lot of the pain points and risk points that are going to be affecting the majority of all people. And as promised, I want to show you that the supply chains are getting better very rapidly. You can see it on this chart. This line represents the supply chain backlog, the amount of stress on the system, and as it declines, that's showing you that efficiencies are coming back to what was a big bottleneck. There's more space on ships now for containers. It's not about the destination, it's about the speed it takes to get there. Look at how fast this fell. This was the biggest port backlog I think we've ever seen, and now it almost disappeared in a very short window of time, within about a quarter. Global supply chain pressures decreased in September, marking a 5th consecutive month of easing. That's from the Federal Reserve Bank of New York. There's less of a backlog. We're starting to come back pretty strongly now, which will be one of the forces pushing against inflation that I'll talk about in this video. I'll also talk about that you're paying more for certain items. I'm also going to talk about how there's a lot of forces pushing inflation higher as well. But however you look at it, right now, overall, retail price inflation is starting to decline. And I expect that trend to continue. This is from Capital.com, and I wanted to point out one thing. While inflation is likely to haunt the markets for the rest of 2022, terms like disinflation and deflation are slowly starting to trend as new market narratives take shape. But I'm glad that they're catching up to us, you guys. Many remain optimistic that the Fed can pull off a soft landing as early signs of slowing inflation begin to take shape in the form of falling commodity prices. For now, the Fed's ultra-hawkish stance helped bring down copper prices to 17-month lows. Aluminum prices, which hit all-time high levels over 3 months ago, have fallen over 30% from the peak. Crude oil prices have also shown signs of easing. Here's charts of copper, aluminum, and oil. You'll notice all three of them are trending lower as we roll into recession. So maybe you're wondering, well, where is inflation not going up? You're seeing it in all the grocery store items, but there's also still inflation in your wages, very, very minimally, but they're increasing. There's inflation in service costs. There's inflation in the prices of rental units. That'll be a lot of factors pushing rental prices higher. But here's year over year CPI for fresh fruit. You're paying 8.2% more than a year ago. Bread plus 14.7%, milk 15.2%. You're paying more for meats, poultry, fish, eggs, 9%. Rice 13.6% more. But people often look at that and they say, wow, in 1 year it costs 15% more. And then they assume that it's going to cost another 15% more after the next year. That's not how it works. What's going to happen is that this will moderate. Inflation will jump up, as it did, pretty significantly in a very short window of time. Just like with any stock, 80% of the move in terms of magnitude happens in 20% of the time. That's true of most stocks. That's true of inflation. So you saw a big jump in a short window of time for prices, and then it crept up a little bit, and it's starting to moderate. But where is inflation declining? There's some places or some areas where there are lower prices right now. You remember lumber cost such an extreme amount and it started putting a lot of pressure on home builders. That's normalized, for example. This is one example off the top of my head, but let's get into it. We're also seeing big declines in commodity prices. Copper, Dr. Copper, it's in everything. That's how you can watch the demands on copper or the usage of copper to see how the economy is functioning, how active it is. Just like velocity of money is another one. There's a lot of ways to look at things. But copper prices are down pretty significantly. And you guys know gold prices are obviously down pretty significantly as well. There's also a decline in import and export prices that I'll show you on these charts. When we all went into lockdown, a lot of people bought exercise equipment. They turned their garage into a man cave. But you're not going to do that again. You're not going to take on those costs again. And according to the Conference Board, shoppers' plans to purchase big ticket items have declined. So why is that? Because everybody bought what they wanted to buy at a time when they wanted to live that lifestyle or had to live that lifestyle. And now at the same time, there's inflation making everything cost more. And so that's absolutely slicing off a lot of the discretionary income. So you make different decisions. You say, well, I spent so much extra money on groceries. Now, you know what? Forget it. You guys know all this. I got to keep moving here. As I told you that inflation will get greater and greater. And now I'm telling you that it won't go too much more from this point. It'll go up a little bit, but not too much more. People are worried about it way too much. Inflation is a temporary thing, and it's going to be declining coming up pretty soon, in my opinion. And this is from the CEO of Walmart. I found it interesting as well, as did he, that the fastest growing segment of shoppers at Walmart is people who make over $100,000. Why is that? It's because they are reacting to all these pricing pressures as well. They're starting to choose during this economic turbulence. The point is that what you saw in retail, the shocking numbers, where it's gone up 9.2% in a year for whatever item, the worst of that's behind us. And now we're looking at a bad job of reacting to the lockdown and the reopening trade by most companies. They've got way too much inventory right now. And that includes used cars, new cars. It includes things that you're going to see in this extended holiday season. Now they're going to have to extend the holiday season to really push a lot of these products out onto you. They'll have blowouts, they'll put big discounts on everything, they'll advertise more. So there's an oversupply as the supply chains are improving rapidly. And I'll show you again on this chart. What else do we know? We know that shipping costs are falling. We know that there's a new availability of shipping containers. If you remember not too long ago, the whole thing was that there weren't enough shipping containers to ship all this stuff. Then we had the port backlogs and the whole lockdown, et cetera, et cetera. But now there's spaces available. If you want to move goods from China to America, it's a lot easier to do it now than it was a month ago, 2 months ago, 3 months ago. And this chart of personal consumption expenditures shows you that the consumer is still strong. And this is, America is a consumer-driven economy. There's been an 8.9% increase in consumer purchases. So that'll help shave off a big part of most of the inventory gluts. But you'll see that we're going to have a really long holiday season this year. And you're also going to find a lot of stuff you can buy at a very deep discount, and it's going to be advertised to you right in your face when you walk in the store. It's going to start happening now. A big deflationary housing wave is approaching. We're going to see a deflation before we'll see extreme inflation. Investors are selling risk assets over fears of tighter monetary policy. They're listening to rhetoric from Fed officials who have a horrible track record. There's a deflationary wave approaching that should ease concerns over inflation and higher interest rates next year. And this is from the U.S. Bureau of Labor Statistics. CPI for September was only up 0.4%. I say only, that's not really only, that's actually a big number for 1 month. The unemployment rate right now is 3.5%. And here's where you made a bit more money, average hourly earnings, but it's only up 10 cents on the month. The U.S. import price index is down 1.2% in September. Export price index down 0.8%. Now listen, it's not about, though, cherry picking certain numbers to make your case. I say inflation's going down. I could say here's 12 things where prices are lower. Somebody says it's going the other way. They can give examples too. It's not about cherry picking items. It's about the overall trend. And the most important part of it is, how does it affect you? What happens to you when you go to the grocery store and you print off the receipt and you look down at the bottom and that number is shockingly higher than you expected? That means you are being impacted by inflation. The good news is that I'm showing you it's going to start coming down. And always remember, I'm talking about consumer price inflation. I'm talking about the price on your grocery bill. How much does it cost for a block of cheese? I know that there's other definitions of inflation, the expansion of the monetary supply. That is the correct definition. I'm talking, though, about how it affects you directly in your pocketbook. But it's an example of what you're going to see a lot more of are calls for less growth than expected, because the combination of supply chain uncertainty and the rising costs will be putting a strain on every aspect of economic growth. Every company will be affected. Every individual who's a consumer in America will be affected by these things. And a big result of that, down the road a little bit, you'll see that growth rates for the USA will start to decline. And also remember that there's the delay before the interest rate increases actually have an impact. And we're rolling into that over the next couple of months. But what are interest rate increases? That's the Federal Reserve saying we'll punish the economy. We need more unemployment. So we're going to make people lose their jobs. We'll make people pay more for money that they borrow. And that'll make everything worse. So slow down the economy. And then we can say, yes, we did it. It's insanity. It's clearly obvious insanity how this economy functions. And this is an article from CNBC just the other day showing you the prices of things, how boneless, skinless chicken breasts have declined 23.6% from a month ago. That's a 1 month decline, almost a quarter of the cost. Butter's down 13%. You can take a look at it. Car rental's down 9.5%. It just takes a while to work through. When things get less expensive for wholesale, that means it's less expensive for them to provide for retail. And then retail provides it to you on the shelf of the store. But that takes the speed of business. So we're talking a couple of quarters at very least. So just to close out here really quickly, this part's good, so stick with me. I'm going to talk about a lot of the forces pushing inflation higher right now and a lot of the forces pushing it lower right now. So what's moving inflation up is included but not limited to the media-driven frenzy every time you turn on the TV. Big headlines, and they're telling you that everything costs way more. But the actual media push, it makes for good media, I guess. It's actually making inflation worse. If you expect inflation, you're more likely to buy things, spend your money, and that also makes inflation worse. And of course, the supply chain disruptions were making inflation very much worse, but those, as you know, are coming down. So that inflationary pressure is being lifted. Of course, the war was inflationary. Most of the impact of the war, in terms of inflation, happened in the very earlier phase of the war. When the economy gets hotter, starts functioning more actively, velocity of money as it increases can be a force also stoking inflation higher. And you can see the activity of an economy after the fact by getting the readout of the velocity of money. How many times a single dollar is used as it cycles its way through the economy over a given period of time. And there's been unmatched monetary creation, the likes of which no one has ever seen. Here's a chart of how much money was created. Consider that inflation. There's your inflation right there. They've increased the monetary base. This is from the St. Louis Fed. So what's moving inflation down? Technological advancements? You're not paying as much for VCR as you used to. Inventory gluts, as we're seeing build up right now and will be dealt with over the next 6 months by the companies, I mean. Jawboning of the people in power who are talking about we're not going to stop fighting inflation until we're done our job. That jawboning can make inflation go down as well, slightly. Increases in interest rates hurt the economy, and so that is one of the things that'll make inflation come down as well. It's the most publicized, obviously, but there's a lot of reasons why inflation moves around, not just interest rates. Rising unemployment, as we are going to see shortly, will also be anti-inflationary. And with everything coming down, stocks, cryptocurrencies, soon real estate, with all that coming down, in my opinion, that is also a force pushing against inflation, as would be any slowing of economic activity, which will happen if you raise interest rates, as they did. So what's next for inflation? I believe that overall, and I say this a lot, I think, but I believe we're in for a very tough economic time. And I'm hoping that you're going to allow my insights and my opinions to help guide you through this. And I feel like you're helping guide me as well, because I have to learn things to tell you, and then I learn them, and then I know them. So you guys are helping me get guided through this economic clown show, just as I'm trying to help you. So, in my opinion, what's the very best case scenario? I believe that, and it's my premise, that the best case scenario, if everything lined up and the stars aligned, the best case scenario would be a very significant recession. And then the possible options, I believe, just get worse from that point. That's why I think you need to really pay attention to this stuff and prepare yourself and get ready for it now. Do what you can. It might make a big difference. But during economic hardships, what happens? I expect that the overall economic activity will slow down, and then you can see the results of that after the fact in the velocity of money indicator. I believe that unemployment will rise through whatever level of recession we face. And as you know, I expect a significant increase in delinquencies, bankruptcies, and defaults. What's a delinquency? You got a car loan, you can't pay it. What's a bankruptcy? Your company can't make enough money to operate anymore, pay their creditors. What's a default? You owe money to a counterparty and you don't give it to them when you've agreed to give it to them. We're going to see all three of those more than you've ever seen in any period of your life up until this point, once it starts. And the next video actually is about exactly this. I'm going to show you where we're at with all of this. And other things that I anticipate for the populace going through, we're going to go through, and I'm talking about everybody. Other things I anticipate are a big deleveraging. And what is that? How does that work? Because margin calls are an example of that. And it's not that people decide I'm going to have less debt and they'll be tighten up their bootstraps or whatever and pay down their bills and things. When the stock market comes down, a lot of people who have been investing on leverage, and even with some cryptocurrencies, how much they've come down, a lot of people will then get a margin call from the broker and have to provide more cash into their brokerage account or sell some of their stocks. What happens is that the broker does not want them to have so much borrowed money out in the market. When the market starts going the wrong way, a lot of margin calls start to trickle in. The further down it goes, the more margin calls there will be. One of the results of that will be a decrease in the amount of leverage out there. The fact that houses are too expensive to buy now, that interest rates are making it too difficult to get the house you want to get. People are just waiting on the sidelines in terms of buying real estate right now. That will also factor into the fact that people will have less overall debt. They'll have less leverage. They'll have smaller mortgages. There will be a massive deleveraging. There actually has to. And one thing I put on the script, I said, maybe oil prices fall. That would be very deflationary or anti-inflationary, I'll say. And I say maybe oil prices will fall because there's way too many significant factors that could be brought to bear at any point in time and throw the oil price around. You can't, and the thing is that a lot of the reactions to move the oil price around will be because of how the oil price acted. So if oil prices come down, Saudi Arabia says we'll cut production, pushes oil prices back up. But then what's happening with that? That's going to be a different video. It's a long story. The American administration and Saudi Arabia are having a little bit of issue that we got to talk about. It's a separate video, I'm telling you. So maybe oil prices fall. That's one of the things I would expect in an economic downturn. And since stocks and bonds and cryptos all came down together, as I told you ahead of time that they would, then now what's going to join them next? Real estate. And this is all during a time when supply chain disruptions are getting better rapidly. Better meaning less disrupted. And that's happening as the entire global economy is slowing down. During all of this time, what I'm trying to get at is I do believe that consumer price inflation will decline going forward for a certain amount of time before it reverses and starts going much higher when we get into hyperinflation, when the government goes back to quantitative easing, as they've been already making noises about maybe doing. There's a lot of talk about this stuff. Not all of it makes it to the headlines. So thank you guys again. This video is made possible by and dedicated to the very first sponsor we've ever had on a Peter Leeds YouTube video. All the people who joined the Peter Leeds army. You guys are so important to us. You guys are giving us new life. I've got tiger blood in my veins.